When the crypto market starts tanking, it often feels like your entire portfolio is helplessly getting crushed. But what if there were strategies that let you trade those downtrends and actually increase your crypto returns?
Yeah, boy.
Well, that's exactly what we're diving into today. In this video, we'll explore 5 ways to enhance your crypto performance even when the charts look horrific. My name is Colin, and if you want to keep pulling in gains during the moments when your timeline insists that the sky is falling, then this is one video you seriously don't want to miss. Before we jump in, a reminder. I'm not a financial advisor, and nothing in this video should be taken as financial advice. This content is purely educational and designed to teach you how to potentially improve your returns during crypto downtrends. If you're on board with that, hit the like button and let's get started. We're starting with the most straightforward red market strategy, shorting using derivatives. Now, we're not telling you to rush out and blindly short everything in sight. If you have a strong, well-reasoned short thesis, great, but that's entirely on you. Instead, what we're talking about here is using shorts to hedge your portfolio without taking on directional exposure. So, how does that actually work? Let's say you're holding 5 BTC, but you're convinced the trend will continue downward. You don't want to panic sell your Bitcoin, so one way to hedge is to short 0.5 BTC on perpetual futures at 1x leverage. Doing this neutralizes your directional bias. If BTC drops, the short profits. If BTC moves up, your spot holdings benefit. You might now be thinking, okay Colin, my exposure is neutral, so how do I make money? Good question. The answer is funding fees. If you're new to this, funding is a recurring transfer of payments between longs and shorts designed to keep perpetual futures prices aligned with spot prices. When perpetuals trade above spot funding is positive longs pay shorts. When perpetuals trade below spot funding is negative shorts pay longs. Exchanges distribute these payments several times a day, and the rate fluctuates constantly. Since the crypto market usually leans heavily long, funding tends to stay positive. That means a delta-neutral short can collect funding payments over time. This is the core of the basis trade. Fortunately, funding remains positive far more often than negative, even during downturns. Most exchanges target roughly 0.01% as the equilibrium funding level, and rates oscillate around this rather than staying negative for long stretches. So even when the market looks disastrous, a hedged short generally earns net profit over time. A big advantage of perps is that they never expire, hence the name. No expiry pressure like you'd see with options or quarterly futures. You can keep the hedge active as long as the funding makes sense. But remember, funding is variable. During choppy price action or panic events, funding can swing negative for periods and turn your carry into a cost. In extremely bearish conditions, funding can even become deeply negative. This is still a managed trade, not a set and forget strategy. And note, exchanges sometimes adjust leverage rules during extreme stress. For example, during the last liquidation cascade, where $19 billion in positions were wiped out, auto-deleverage, ADL, was activated across many platforms. ADL can trim profitable positions, including shorts, to stabilize the books. Rare, but possible. Options as another short tool. Options are another way to express a bearish thesis. An option gives you the right, but not the obligation, to buy or sell an asset at a certain price before or on a certain date. Options are a clean way to cap your downside while keeping your upside open beyond the premium paid. But the difficulty lies in complexity and timing. Even if you're directionally correct, you won't profit if the price move comes after expiry or isn't large enough to overcome time decay. There are many ways to structure option trades to minimize those issues, but unless you're ready to dive deep, it's usually simpler to stick with perps at 1x leverage. No expiry complexity, fewer variables, and an easy way to farm positive funding. Final note on derivatives: counterparty risk matters. Only use reputable exchanges with transparent risk systems and keep your position sizes reasonable. A hedge is meant to reduce risk, not add tail risk because you decided to crank it up to 50x. Next, boosting returns using yield. If you're holding crypto long-term, there's almost always a way to put those assets to work instead of letting them sit idle. Let's take ETH as an example. Native staking pays protocol rewards for helping secure the network. If you choose a decentralized route, you can stake without giving up custody. APR will vary depending on network conditions and the provider you use. For instance, Lido currently offers an APR of 2.6%, but you can go further with liquid staking. With Lido, you deposit ETH and receive STTH, which accumulates rewards and can also be used across DeFi as a receipt token. You can deploy STTH in money markets, liquidity pools, and other yield avenues. But be aware of liquidity risk. In times of stress, STTH has traded below ETH. This can break leveraged loops and trigger forced liquidations, as we saw during the 2022 deleveraging cycle when STTH temporarily slipped below parity and some users were liquidated. So yes, liquidity matters and peg breaks can be painful. Be cautious about stacking yield strategies. Another angle is crypto lending. Platforms like Aave allow you to lend your crypto and earn interest. Aave has a strong track record. It handled October 10's massive market crash, with roughly $180 million in liquidations processed automatically without pausing. Impressive resilience. Rates vary during downturns, borrowers retreat, so ape-wise fall. But again, the goal is to earn yield on assets you'd hold anyway. Of course, lending carries risks, protocol exploits, Oracle mispricing, etc. Nothing in crypto is risk-free. But staking and lending both help you generate extra returns while everyone else panics over a sea of red candles. The third method is arbitrage, profiting from price differences of the same asset across different venues. In market chaos, the same token can trade at different prices on different exchanges due to panic selling or liquidity mismatches. Arbitrage is simply buying low on one platform and selling high on another. These opportunities frequently appear right after huge leverage washouts, such as the one on October 10th. Stablecoins can also depart temporarily. On-chain pools, like Curve or Uniswap, sometimes get overwhelmed by one-sided flows, pushing a stablecoin to 99 cents or even 98 cents, while centralized exchanges still show $1. Traders with capital on both sides can scoop up these spreads until the pool rebalances. These setups often offer some of the easiest short-term profits you'll ever see. Execution risk, however, is where most newcomers fail. During heavy volatility, centralized exchanges frequently lag or freeze, precisely when the spreads are best. And those spreads exist because liquidity is strained. On-chain, gas fees skyrocket during stress, which can instantly turn an otherwise profitable arbitrage into a losing trade, especially once you factor in slippage. To succeed, preparation is key. Maintain funded accounts on at least one CEX and one DX per chain you operate on. Know the withdrawal queues, deposit times, fees, and settlement delays. When markets get turbulent, inefficiencies appear, profitable for whoever is ready to act. There is always a bull market somewhere. If crypto is risk-off but stocks or gold are pumping, you might simply be better off focusing on those assets. You can even do this through crypto platforms now, since many offer tokenized stocks and gold products. For example, during September and early October, crypto was choppy and ultimately suffered a major long wipeout event. Meanwhile, gold pushed to new all-time highs. Not saying you should pour everything into gold, especially given how many people were lining up worldwide to buy it, which usually suggests a top, but it highlights the fact that opportunities always exist somewhere. Also remember, even if BTC is trending down, certain altcoins may still show green candles and maintain an uptrend. Just treat them as short-term plays. Outperformance rarely lasts long during broad market weakness. And don't forget, cash is a position. Sometimes it's the best one. Warren Buffett's Berkshire Hathaway is currently holding nearly $350 billion in cash, a record amount. If the world's most respected capital allocator waits patiently with mountains of dry powder, you can too. Optionality matters when markets are uncertain. Our final method doesn't create short-term gains during corrections, but is one of the most reliable long-term strategies ever used. Dollar cost averaging, DCA. This involves buying a fixed dollar amount of an asset on a regular schedule, regardless of the price. No trying to catch bottoms, no timing stress, no brag-worthy entries, just systematic accumulation that smooths your cost basis. DCA is not a short-term downtrend strategy. Over the long run, however, these buys often become some of your most profitable. Why DCA when the chart looks terrible? Because market psychology is brutal. Downtrends force you to buy when it feels awful, and that's exactly where DCA shines. It removes emotion and prevents panic selling after months of accumulation. The key ingredient is conviction. If you're going to keep buying while the market screams doom, it must be in assets you genuinely want to hold for years. For most people, that means BTC and ETH. Many altcoins never reclaim old highs after their hype cycle ends, while major assets continue to build network effects. Automation helps too. Most exchanges offer recurring buy features, letting you stick to the strategy without relying on your emotions. If you want a more advanced version, there are variations like value averaging, targets a portfolio value, buying more after large drops and less after big rallies. Threshold DCA keeps timing fixed but doubles buys if the price drops, say, 20% below its 30-day average, or halves them if price rises 20% above. Whatever method you choose, keep these practical points in mind. Pace your capital. If you plan to DCA over 9 months, don't deploy everything in 3 because the first downturn felt huge. Set an invalidation point. If an asset's fundamental thesis breaks, don't keep buying it into oblivion. Zoom out. With BTC especially, time in the market usually beats perfect entry timing. Bear markets are brutal, but many legendary investors swear by DCA. Leave the perfect bottom screenshots to crypto Twitter. Those are the top strategies for adjusting your trading and investing approach during red markets. Did we overlook something? Do you have methods you rely on? Drop them in the comments. If you want more on preparing for a bear market, check out the related video linked on screen. That's all for today. Thanks for watching, and I'll see you next time.